I think everyone knows who I am. Financial Freedom Club. Really happy that we're getting this. This is session 3, and we're going to get through what we're trying to achieve from this. Agenda overview, what is Financial Freedom Club, what the areas that we're going to cover to master to become financially free, today's focus, a bit of Q&A as well. This is the reason why we set this up. Why do people struggle to get financial free? Often they don't know how to structure this and the steps, and they definitely don't know how to implement them. And this is why us and the team are doing Financial Freedom Club, is to hopefully help everybody really accelerate that journey, because until you start, you're never going to get to the end. Don't know if that's going to become the tagline of this, but it's all about, as I say, unlocking financial freedom, which is in the background. These are the areas that we cover in this. We've been focusing in these sessions initially on personal finance, because I think that is one of the most important parts. That's the building blocks, because everything tumbles. Then we'll get on to business finance. That's a huge area. Then you've got wealth and assets, which is also quite big, and then retirement legacy. Depending on the different aspects, we will probably have other people involved in these as well. The reason being is there is so many different facets to all of these, and more you learn, more knowledge you've got, the better. So today's focus, as I said, we're going to be looking at personal finance, such as personal finance cash flows, right, and mortgage early settlement. And everyone probably knows why this is important, because one of the common questions I get from people is, Z, I want to be able to finish my mortgage earlier. And I'm going to give it literally 1 minute before I start into the main aspects of all this. And anyone who does miss it, if you're watching it on the recording, we'll have it all on our suite, and we'll put all these on there. But obviously, you'll miss the Q&A, and any questions that you want to answer, get us to answer, please do ask them after I finish the little presentation and going through this topic, to give you an idea of how to assess what the value of finishing a mortgage early is. And the pros and cons, because there is some cons as well. It's not just all pros. And it depends on what you're doing and your own circumstances. I always emphasize that. And as I said, at the end, we'll have a Q&A on the presentation. I'm going to jump into it literally now. So what I'm going to do is there's a little template, and what I'm going to concentrate on is, as we're speaking right now, we're in 2024. What we're going to do is we're going to assume that we started our mortgage next month, i.e. August 2024. It doesn't actually matter when you start this. This is a really good template, which I've sort of butchered of someone and sort of changed around. I'll be honest, it's quite important, but it does exactly what it is supposed to do, as we're going to cover. What I'm basically talking here is around value. Right? The value of the mortgage, actually, I'm going to do is a bit higher than this. It's actually going to be a much higher number, and I'm going to get onto what that number actually is. What we're going to do it is based on 200,000, and I'll put the annual interest rate, which is actually, as we speak, what the Bank of England rate is. I know people may have the mortgages cheaper, some may have slightly higher. It only impacts you at the beginning when you actually put the numbers in. It gives you an understanding. So what I'm going to talk about is break this up into, I've done 4 pre-worked examples. So I've done it on a £200,000 mortgage, what the interest rate is, and how long the mortgage is. If anyone is good with their maths, that's 30 years. I thought I'd put 30 years, which is 360 months. And it sort of works out what the payment is. Please note, I would always work out on your calculators, because every mortgage provider, whichever bank or lending institution it is, they will have slightly different, what we call an amortization schedule. And this is how, and I've got the American spelling as well as the UK, just to make sure we keep everybody happy. This is how they spread the payments in reflection to 2 aspects. One, the capital, i.e. what amount you borrowed, that's what the capital amount is. That's over here. And what is an interest charge. So what they do is, even though you are paying interest, what actually happens is the interest payment is much higher at the beginning compared to the end. Because what they do, all of them, this is everywhere, when you pay, the front is where all the interest is loaded. And the reason why they do this and get away with it is because they say the highest amount of borrowing is at the beginning because you've not cleared anything off. So at the beginning, if you look at this between the two, the amount of capital you're repaying and how much interest you're paying, if your mortgage is £1,100 a month and it's on a £200,000 mortgage, is quite scary because that amount stays the same. That assumes that every month, on the last day of the month, you are making the payment. And we're going to go through some magic. You're going to love this. And if you're watching this, this is so important because the mortgage is your biggest cost and biggest risk that you will have as an entrepreneur or an employee. The reason being is everything else is not as big cost as this. Even your car, generally, depends what car you get. But they base it on compound interest. And compound interest right now is not working in your favor. And that's why you can see what is actually happening here. And it is quite scary because if we have a normal loan mortgage and we do over 30 years, believe it or not, on a 200,000, you're actually paying almost 400,000. So the mortgage doubles. So half of it's interest. Can you actually believe that? And I was going to use a verbal obscenity, but I'm not. I'm going to be polite. But that's like, it's doubled. This is absolutely madness. You pay interest as much as you borrow over a 30-year term. And this is obviously for 5.25. If you do other rates as you play, it actually becomes worse. It doesn't become better. It's quite an eye-opener, and that's why I put in, and you can actually go down here, if we do something a little cheeky, if I go to the bottom, you can see I'm paying this all the way through. And at the end, my interest is nothing and it's all capital. But what's happened at the beginning, my capital is really high. And you can see, look at the capital outstanding. It's hardly at all going down. And I'm just going down here and I'm going to just go, there's an area where it really opens your mind, is there's a point where the capital actually becomes more than the interest. And that amount, I might have gone past it, just go up here, it's about here, isn't it? Look at that. That point, so that point is on the 203rd month. If anyone is good at maths, they will work that out. And I may put that little quiz, I'll do it for you. So 200 months, let's see if my maths is any good. 12, that's 15 years is 180. 16 years is 192. That's 16 years, 8 months. That's more than half of the 30 years when you are paying more towards interest than the actual capital of your mortgage. This was probably the easiest way because you can see that goes below 100. Well, you can't even see there, but the closing balance is still higher. So because you've paid so much, even though you've now started paying more towards your capital, but you've only paid back 75,000, which is a third. You can see it, the outstanding mortgage is 62%, which is almost 2/3 of your mortgage is still outstanding when you actually start paying more. This is how they make money. And this is why Einstein's famous saying, and he was interesting about this part, he did talk about it, he said, compound interest is the 8th wonder of the world. And if you understand it, you will be very prosperous, and the people that don't, you'll just be a slave. That's me probably paraphrasing the last part of it. So if I don't do anything, I'm going to be lumbered with almost 200 grand worth of interest. Just let that digest for a few seconds. On a 5.25, the current mortgage, if I go and get a mortgage start of August, and I pay the Bank of England base rate, I will pay over 30 years the exact amount that I initially borrowed. So the bank on me has doubled my money. This is, please note, these are on capital repayment. mortgages. That's why there's an end there. Because if it's not, then you never pay back. So if you do an interest only, and I'll probably explain this quick difference because I think this is quite useful, especially all the different people that we got on here may not have had exposure to mortgages. An interest only mortgage, okay, is where you just pay the interest and the capital never drops. A capital repayment is where you pay some towards the capital and the interest, but they do make a lot of money up front, and we'll get onto some questions about this. The next one, my little worked example, is if I go up here and I pay 50% extra. So that means I'm paying my mortgage payment of £1,100, and at start of the month, anyone spotted the mistake that I've made? I haven't changed the dates on this. If I change the dates, that's quite relevant if you change the date, because that actually drives all of this, and that should be, if I do it here, if I do that, bam, it works. See, you can use it. Good example. The rest of them I've changed, or I haven't changed that one either. So this is if I'm making a 50% extra payment at start of the month. Really important when you make it. If you notice, I actually, and I hope you're ready, if I go back here, can you see it doubled? If I just carry for the whole 30 years, just making my standard payment at the end of the month, or at the start of the month, I should say. Now I'm making an additional 50%. That's a £552.20 payment. So if I make an additional 50%, what happens? The mortgage drops by £115,000 approximately. And I actually finish, hope my maths is right, 14 years, 8 months. So I finished the mortgage in less than half the time. So I had a 30-year mortgage just by making that additional payment, half of my payment, £552.20 at the start of the year. Let's see, can you see there, at month 176, 15 years is there, that's halfway. It's actually 14 years and 8 months, yes, wow. So a 50% payment, overpayment a month. What you've got to be careful, by the way, everyone, is there is some restrictions on overpayments. That's why I've done it this way, saying 50%. Because depending on what your mortgage is, they only allow you to make so much overpayment. So you really need to make sure you look at the terms of the mortgage. Really important when you take it out. If your strategy is to clear the mortgage off quicker. So quick check, always check your terms before you sign them, and think about how you're going to deal with the mortgage. The next one is quite an interesting one, is if I make, because most mortgages, just to give you insight why I've used these two buzzes of 10%. So most mortgages, what happens is they allow you to make a 10% overpayment in the year. Please do look at that, because provided they let you, most of them do, and there's two variations. This one is 10% of whatever my balance was at the start of the new year. So 10% of 200 was 20, but by the time I got to year 2, which is 13, at month 13, it's 10% of that. That's why I've done that, because if I leave it at 20 in this case, which is most mortgages, by the way, they've got this restriction, I would end up having early redemption charges charged on any overpayment. So it sort of defeats the point. I don't want to be paying fines and interest when I don't have to. So in this case, on most mortgages, they only allow you to make a 10% overpayment. So what I've done is made the overpayment right at the beginning. You could have spread that, by the way, over the year, but I've done it to give it the maximum impact. So I made 20,000 right at the beginning. What does that do? Wow. Wow. I've basically saved £150,000. Because if I go back here, no repayment, it's almost 400,000. A 10% annual payment in the first month, right at the beginning, is only 250 or 249 to be exact. That clears my mortgage. What did I say? In the buzz line. Hope the team sent it on the post. Hope you know what I was saying now. You can see it's reality. Z wasn't just making it up. 11 years I've cleared the mortgage. With most mortgages I can do that in the United Kingdom. Because they have this restriction of overpayment, I can clear in 10 years, 10 months. Let's see if I am actually telling the truth. You can also see something amazing here, because I'm just going here. I always look at the time when my capital payment becomes more than my, and it happens right there in the third year. In the previous example, when we made this payment, it was about year 16 when I was paying 50% every month. But making these lump sum 10% payments at the start of the year on the actual balance, I'm actually, by the time I start year 4, 37 months, I'm actually got more than capital. I've only got 60% of my mortgage left, but my interest payment only ends up being 48,870. So it means I'm only paying £250,000 back on a 200,000. And does it work? Is he talking rubbish or is he being real? No, he's right. Don't you love it? 10 years and 10 months. So month 130, I know it's only £1.12, so it could be 10 years, 9 months, right? You've actually cleared all your mortgage off. I just let that sink in a little bit. So these strategies do work, and anyone who tells you they don't, they're telling you whoppers. They do. But it depends on what your circumstances are and why, and we'll get on to later why we would do these things. But I wanted to work these calculations and show you, because the magic that this is mind-blowing. If you were in a live audience and I was presenting and I could see you, I would say, who's got their hands up? I'll ask them for their hands up. Who's got a nationwide mortgage? Because nationwide for me is still probably the premier gold standard mortgage. Why? Because it allows you to put 10% of what your original balance any time in any year. If you look here, in the second year, I can still put 10% of my original 20,000. I don't have to go down here without mortgage redemption. Nationwide was the only one when I checked a few years ago that allowed you to do it. Please do check your terms and conditions, speak to your mortgage broker before you make these decisions, because if you overpay over the threshold, they will fine you in with interest and it defeats the whole point. But look at this. Look at this. Wow. 236. So I started here, don't know where the penny's gone. It was supposed to be 200. I only pay 36,000. Let's go back to do nothing. I pay almost 400,000. That's £200,000 worth of interest. If I pay 10% every year at the beginning, I'm going to only pay 36,000 interest, 236 or 37,000 interest. Can you see here? And this was the headline. Can I finish a mortgage in between about 7 years? Yes, I can. If I got a nationwide mortgage, it's 7 years, 5 months. Let me see if my numbers are right. Let's go. There it is. 7 years. For the old mathematicians are there. Hopefully my numbers are not bad. 84 months is 7 years. It's actually less than 7 years, 4 months, or even 7 years, 3 months if you just paid the lump sum, because you can. But this is where you can pay this. And look how much interest you are saving. Wow. Mind blowing. That's £163,000 worth of interest. And who said the Financial Freedom Club does not get you financial free? I want to talk to them, because they are talking a load of rubbish. This is value. It's so important understanding this. And obviously all these templates, yours truly and the team will be whacking these on. correction. The team will be doing it on my behalf, obviously, because they are much better at all that stuff than me. And we'll be putting this on because this is knowledge. And it helps you do your strategy. What is right for you? What strategy do you want to do? Look at the money payments. And I'm going to check on this one. When do I get to my capital being higher than my interest? Wow, it happens just about there. When is that? That is in 35 months. There's a marginal difference between the two. So this is 7 years, 5 months using Nationwide or any mortgage that allows you to pay 10% of the original amount every year. The one where you have to pay 10% of whatever the balance is at the start of the year. Wow, there is a bit. The interest is not that much because of it's only about a 12,000 saving on interest, but look at the difference in payments, cash flow. 10 years, 10 months versus 7 years, 5 months. So that's 3.5 years earlier, I finished my mortgage off. Look, let's go to the bottom. Look, 0. I'm really passionate about it. I'm having fun. I hope everyone else is. Because this is life changing for a lot of people depending on where they are. But they just simply don't understand or know this, because the reason why it's so complicated, guys and ladies, is that this amortization schedule blows people's mind. So you have to have, and it will vary depending on how the amortization, but it'd be very similar to this. I've looked on a few different ones. And it's how they front load the interest which hurts people a lot. And I can't emphasize this. Always say to them, can I have the amortization schedule? Tell them to put it in Excel for you. Say, well, I'm paying you money, no disrespect. I'm paying you either 37 grand for the privilege or £200,000 for the privilege. You can whack it for me in amortization schedule. By the way, legally, they're supposed to provide you an amortization schedule. Whether they have to put in Excel or not depends on how you butter them up. Or I want to know how you work it out, because there's slightly different methods depending on where you are doing it. This is a rough guideline of what it does. But you can see the difference. 30-year mortgage, I pay 198 odd thousand, and it's literally 30 years. And I'm not lying, I'm starting at the bit of the white hairs. 30 years is a long, long old time to be paying the bank for the privilege of having your own house. Or I can do the one that's on steads, as they say, on steroids, and really power through that. And I can clear it in 7 years, 5 months. That's the Nationwide one. But I'm only paying them £37,000 of interest. Just let that drop in for a moment. That's huge. If you finish so from the beginning to there, that's 22 years, 7 months. On a 30-year mortgage, 7 years, 5 months, compared to 30 years. The most one probably be this, 10 years, 10 months. You could have people saying, hold on, Z, but you've split it over 30 years. We can do it under less. I'm going to sort of do that, but it sort of changes all the calculations off. But if I had it, the mortgage term under, say, 20 years, it does make it different. You can see there. Let's see if it all works out. Does the formulas work out? So yeah, they do. Look, 240. So you can play around with all these different features. But most people have mortgages over 30 years, and I know I chose 200, but let's just use a couple of more numbers. We love playing numbers, and then I'll go through some of the advantages of doing all this stuff. Let's do 300,000. Can you see? They still double it. It's still double. So I borrow 300, but they double it because the schedule is the same, irrespective of the amount. Yeah? Because what they do is they do the payment and they front load it. Obviously you have a higher payment. Let's go up to £500,000. If you're living in sunny Harpenden or say Albans or somewhere like that, or anywhere around there, look at that. That's almost 500,000. And people just don't know what's going on. They really don't. I hope that sort of made sense, right? I'm going to now go through some of the benefits, what I find, what people, got a little list in case I miss any, and I'm sure. First of all, one of the major benefits side of finishing a mortgage earlier is the worry. As you get older, people just worry more about stuff. They worry about bills, all the headache. By finishing a mortgage earlier, that's probably your biggest cost in life. That's probably your biggest asset, your house. If you weren't fortunate and humble enough to be able to buy one, especially your main residence, that's a big benefit. Second is the risk. So you don't have no hassles of having to make that payment every month because it's your own land. Number two is there's no risk. The bank can't take your asset. And no disrespect, would you trust the bank? Let you think about that. Number three, this is the beauty. Now you can use your savings on the overpayments to potentially do three things. And this is where I love that, because now if you're finishing it, say within 7 years, 5 months, you've got used to making payments of all of this, which is average of 18,000, I think I worked out, per 19,000 a year. You could put that into investments. If you're doing stocks and shares, always speak to a financial advisor or invest a lot of time learning. You could also potentially invest in my favorite, rental properties. So you could use this saving to invest and put a deposit down and create more cash flow, even though Labour may not like you doing that, but who cares? I don't. The next bit is you can invest in a business, probably my favorite, to be honest, because business is got the highest return. It's got high risk if you invest in a business that you're not sure about, but you can use the saving to put into the business as seed money to then generate more returns and use that money in the business quite smartly, because when you invest in a business, it also applies to investment properties in limited companies. You can then save tax, not pay tax in the company to a certain point by investing into a pension and actually have a multiply compound impact. Become the bank yourself. You seen what the bank do? I'm pointing the finger. I'm pointing at my screen. That's what the bank are doing. Why don't you do it to yourself and in a beneficial way? Be the bank. Your limited company becomes the customer and the bank is your pension. My preference, SAS pension, because you can do a loan back from the pension to your own company and buy more property, invest more in the business, charge yourself interest. The interest saves you tax, goes into your pension, tax free, no income tax, no capital gains tax, no corporation tax, and the big one, and they better not get rid of it as I'm speaking in July 2024, no inheritance tax. The other bit is, and this is a bit of a controversial part now, to anyone you speak to. For me, I thought it was just normal, but it's not. You can help your children because you've got less cost. One of the biggest issues we have is legacy. You can help them use a deposit for their house. That's great inheritance tax planning, potentially doing a gift and all the rest of it. It can be hugely beneficial, but that's some of the benefits. And there's a whole bit around that. Couple of cons, there is cons. First one is pretty much one of the only, I think, there's two big cons. One is mortgage actually can be beneficial because inflation, especially when we've had high inflation, actually attacks the mortgage, which is the bank's money, not yours. So think about it this way: if I got a property and I bought this, I bought it for 250,000 or whatever, right? And in 10 years' time, it doubles and it's worth 500,000, and I've still got a mortgage, and I've done interest only, for example. I've just had a capital appreciation of 250, but my mortgage now of 200,000, if I didn't do repayment, is now 40%, not 2/3 of the value of the property. That's one of the advantages, because over time, fixed sums depreciate in that sense, because the inflation attacks it, whereas the property actually appreciates. The other one is quite a sinister one, and you soon realise why the banks get first charges on a lot of the stuff and things, and why they're always a beneficiary, is when it comes to inheritance tax planning and you got your estate, right? When you got a mortgage, and let me use this example, say I've got a £300,000 property, but I've got a £200,000 mortgage. My net estate is only 100,000. If I've cleared the mortgage off, my estate is now 300,000 because I've got no mortgage. Yes, you get something called a nil rate band, and I know there'll be a few questions on this, right? But it could become a problem depending on how much that value of that property is. If that value of the property has gone to 500,000 now, and you've got no mortgage, you suddenly got 500,000 estate, and your children could pay inheritance tax of 40%, depending on how your value of your estate is and how you structured it, and whether you come to see someone who actually knows a little bit about tax to help, especially property taxes, and can manage and plan your IHT exposure, which is hugely valuable, and putting plans in place. Right, I am going to open it up to questions. Has anyone got some questions? Please ask them in the thing. That if you have questions, what is your questions? Don't be shy. You know you got questions you want to ask me. Great question. If you can afford to buy a house without needing a mortgage with cash, should you? This is really interesting. Why? It depends on, if you think about it, an average house in Hertfordshire, if people watching different parts of the country, or Hertfordshire is probably going to be national average, which is 300,000 plus these days. That's a lot of cash to put into a property. Why I wouldn't recommend it unless you've got it, and it depends on your perspective, by the way. There's certain people from a religious perspective don't want to pay interest, or they just don't like the banks, and they don't like giving them anything. That could be a purpose, but generally that's a lot of cash and your risk. The risk is that you're putting all your money in one basket, and also it's a lot of money because you potentially put a bigger deposit and then use the surplus cash to generate additional cash flow. That's what we teach, and that's what the Financial Freedom Club's all about. How you unlock is, how do you spread your money to earn more money in a quite a risk-averse way. I hope that answers the question. Thumbs up, maybe. The next question is there a big difference between interest-only mortgages versus capital and interest mortgage? Yes, huge difference, because I was touching on it. If you have a capital mortgage, right, I would probably recommend that on your main house because you live there and a risk. Capital repayment means that you're actually paying back the capital, so it reduces. That's what I've been talking to probably in this Excel schedule, and the loan amortization. If you have interest-only mortgages, the mortgage will always stay at 200,000 unless you make overpayments. So there's a huge difference. It depends on what you want to do with the money and whether you want to reduce your capital or not. Because some people, what they do is they only do interest only, but they're really savvy with, they still think of it as a capital only. But what they do is either two things. One, do an overpayment, or number two, use additional cash flow, invest in business, either a trading business or a property business. I hope that answers the question. Third question. Is it a good thing to pay off every penny of your mortgage? Is there any implications paying it all off? I think if we sort of go through this, if you, for the pros of doing your mortgage, I think I went through a few, is that you don't have no headache, no risk, you don't obviously huge interest savings, as well. And people feel there's a certain thing about when you own your house mortgage free. Maybe it's psychological, but it's also very relaxing, because then if anything happens, you're covered. I would always recommend life insurance when it comes to this, potentially, in case, and normally it's mandatory, but I would really think about that aspect. So there is implications. It depends on your long-term strategy. And I think I gave pros or cons of both. I hope that covered that. What are the implications of remortgaging? Oh, wow. Right. I'm going to share screen here because this is really, really quite important. So going back to this is the trick that, being an ex member of the banking industry, banker, what they did is they're quite clever. So what they do, and if you look here, and I'm going to explain this by going to the amortization schedule, because this is what it's doing here. When you pay capital, right, and you can ask where this loan, by the way, if I forget, if you have additional payments, you tell them, by the way, that is, you don't want the payment to reduce, you want that to stay the same, and you want this allocated all against capital. If you do not tell them, they will not allocate it, they will pay some towards interest, and you won't get the same result. They're crafty like that. Okay, the question that you asked, really good question, was if you of remortgaging. And the reason why I'm definitely trying to concentrate on the remortgaging is this amortization schedule starts again. That's the trick. So they'll come up to you and say, oh, well, in this case, Mr. Razak, great job. Oh, you've cleared your mortgage off, right? And I'm going here, and now you're paying more capital than interest, right? And now you've cleared up, say, 20 years. And I'm starting here. 240 months is 20 years. And you've got half your mortgage. Do you know what? We actually can potentially reduce your payment down, and you can borrow another 100 grand again, because in 20 years you may want to do that. But do you know what they do? They restart this amortization schedule. And if you look up here at the beginning, what are they doing? They're allocating more to interest, because the interest is always paid at the beginning. So all that interest that you paid on the amortization schedule, forget it, it's gone. They started the whole mortgage again. That's the risk of remortgaging. People don't understand that. It is scary. Sorry to give you bad news, but the benefits can be of remortgaging. That's the biggest implication, and a lot of people don't think that through. However, if you go and use that money to go invest in property and build other assets, that can be quite smart. That can actually grow everything. And I think that's the next question, or one of the next questions. So if you went and took that money from remortgaging and went invested in business or into assets that will make you other income, there will be a return on investment which could be favourable and beneficial. And in more cases it is. Always get an evaluation. However, if you use the money to go on holiday, or go and buy it just because you like a nice car, or you're going through that zone and you want to buy that beautiful car, that may not be a good idea, because it's a liability. Because when the car depreciates or the holiday's done, you still got the debt, and you've got the amortization headache, and you're depressed. So depends on what you do with the money. Next question. Would you recommend renting a room to help with cash flow? Is there government relief for this relation to personal tax? Love it. You know, there's some accountants on here and tax advisors. Yes, there is. So if I rent one room in my house and it's my main residence, I'm assuming it's not an annex, because there's special rules for annexes. If I rent one room, I can actually benefit And what I mean by that is that basically I get up to £7,500 per year. If it's a married couple, they get £3,750 each. It's called rent a room relief. That means I pay zero tax. It doesn't even show on my self-assessment because I can clear it off with the election. So I can earn £7,500 worth of income tax-free, which is £625 a month. The tricky bit is if you do, and it doesn't affect capital gains tax. There's a special rule for that. If I suddenly do 2 rooms, then there's a different issue, and I can only get 7,500 full stop. I can't claim any cost. It's 7,500, that's it, if I do that. So it can be beneficial, but it's worth weighing it up. Get some advice on your situation. What happens to your mortgage when gifting a house? Is there a tax issue when doing this? Wow, the questions are getting harder. Lucky someone can answer those. I will do my best to answer that. There's 3 implications when you gift any of your house, whether it's all of it or some of it. It depends, first of all, is it your main house? I'm assuming for this, it's your main house, right? If it's your main house, the first tax normally when you gift something is capital gains tax. But because it's your main house, there is no capital gains tax, it's 0%. So no problem with that. The second part of the question is, if I've got a mortgage on it and I gift it, there is an issue because I can't gift debt and I trigger something called stamp duty land tax. So you need planning, that can be very painful, by the way, and there's special rules around when you do it and all the rest of it, because if you're husband and wife, there's different rules to the children, different rules between partners who are not married. So get advice, it's worth it. The third tax implication, sorry, there's another one, it's called inheritance tax. So inheritance tax, depending on how you gift it, triggers off if it's worth more than £325,000. So if you gift your main house, it's more than £325,000, you're sharing it. If you're husband and wife, you may have a problem. Get advice. The other bit is, I can't gift a house if I'm dad and mum to my children in my lifetime if I still live there, because it's a gift with reservation. I would then have to pay to my children rent to live in my own house or my former house. So you've got to be smart. There is ways to minimize that and the risk, how you structure the house, and people do that, but you've got to be clever. One of the other advantages, by the way, is care home fees is one of the big ones that people think about houses in trust and gift, because the government can't come after you if you've done it before dementia or something like that starts hitting home. So really get good advice, get it structured properly. It's worth every penny depending on your circumstances. Okay, next one. This was nearly fun. Lifetime mortgages have flexibility, which is good for cash, i.e. pay nothing and or interest up to 10% a year. Thoughts? I think you're looking at equity release. The equity release, by the way, I think is, for most people, are not a good idea. And I'm sorry, whoever's watching it may disagree with me, who has had it. The reason why it's not a good idea is if you've got a legacy, i.e. you want to give something to your children, then they're going to end up feeling the pain of that mortgage. Because what happens is, if I take some money out, I get it, I don't have to pay, but the interest is building up and the amount, and then upon death, someone has got to pay that, and it's normally the people you leave the assets to. If you have no one in your legacy and you don't want to leave it to, then it could be potentially beneficial, but and you want to enjoy life now. It really depends on your personal situation whether that is beneficial. Hopefully that answers that question. It is a sensitive question because unfortunately we're living in times where family legacies isn't the most important. Similarly to remortgaging, what are the implications of equity release? I think I've just answered that. Really good question, because I think it was asked just before yourself, Alfie, by Javid, and it's the same aspects. One other thing, Javid raised a really good question, is the percentage. The equity release, they absolutely cane you on the percentage. And if you look at compound interest again, what are you doing? You're destroying your asset. And that's the bit people don't realize because they don't look at the amortization schedule. Next question. But if you're paying interest and 10%, I think you need to clarify that question because I need a bit more context. Because you're paying an interest and 10%, 10% of capital. But if you're paying interest and 10% of capital, right? Okay, so I guess it depends on what context you mean in that. If you mean that you've got a normal mortgage, forgetting equity release, if you're paying 10%, yes, it is 10% of capital. That's these different models that are done here. So I've done model here, 10% the model here is 10% of the capital at the start of the year. Obviously, you can pay it any time during the year, but it affects your interest. So if I changed this and said I'm going to pay every month, and I divide it by 12, because remember it's 20,000, it changes the interest. You can see the numbers changing. So I've spread it because I'm allowed to, because the interest will still be building for the rest of the year. So depending on what you do and when you do it, it makes a big difference, and that's what you can play around on this schedule, and that's why we've done it. I hope that makes sense, Javid. Can you add beneficiaries to the mortgage? Wow. Okay. Interesting question. Depends on your mortgage terms. Normally, when you add beneficiaries, right, it depends on what context and how you structured that. If it's like they are getting a beneficiary during your lifetime, or they're going to get a percentage, then it's like a disposal, and they actually built the house, and you have to set it up in a different way. You can't have like joint ownership between husband and wife. You have to do something called tenancy in common, maybe for a trust. There's a whole process to it. But what you actually normally what people do is put that part into a trust and then define the beneficiaries, because if you put them straight on the mortgage and they put the beneficiaries, they actually own a percentage, because the mortgage companies are a bit funny around that, because they don't want someone to have a debt and not ownership, because then there's an argument whether they're accountable or have any obligations to pay the debt, because they'll say, hold on, we don't own any of it. But if you have them as own 10%, then they own 10% of the debt, and there could be a stamp duty land tax issue as mentioned before. So you've got to be careful on that. So there is implications of beneficiaries depending on what you're doing. I think I've answered the 10% capital question up here. What else is there? Okay. So one basic planning between husband and wife, unless someone asks me questions, I'm watching out for them. I hope I've answered that, Javid. I know there's a few variations, but if I've got a husband and wife and I'm using that example, and I want to really be smart, what I would do, I wouldn't own it joint. Because what that means is, imagine this room, what I'm sitting in, good old office, is the house, and I own it jointly. That means every square yard or square meter is jointly owned. That's a problem, because upon death, I've got an issue of who's getting that property and inheritance issues. If I do it tenancy in common, I can actually be smart and say I own 50-50 of that house and split it halfway. So I own this half, the wife owns the other half, and then we both could give a bit to a trust and plan our inheritance. And that trust, we can decide who is the beneficiary of the trust. Because there's three parts in trust. I know I'm getting into trust, but I think this is quite important. There's the settler, that's the people, i.e. the husband and wife that are putting the money in. There's the trustee who run the trust, right? And then there's the beneficiary. who's getting the benefit. Normally the beneficiary, you wouldn't want them to be the trustee necessarily, because you can control, and if the beneficiary is one of your children and you fall out with them or they marry the wrong one, you can change who the beneficiary is. And if you put them in a trust and you educate them, that trust, depending on if it's a discretionary, I'm talking about a specific type of trust called a discretionary trust, you can decide how that allocation is from them to how they get the money or get the asset, depending on what the tax position is when you guys, your husband and wife, pass away. So you can actually protect them in divorce as well by doing this smartly. This is how the wealthy stay wealthy. They get good advice, they structure, they look at the journey, and they make sure they do it in an efficient way. I love that. I love that, Joe. You put a smile on my face. You cancel the Netflix subscription. Save the money. Invest in making more money, i.e. into assets. I've actually got the Netflix to get the kids off me, but I guess when they get older, I'll get them to pay it. But I think this is really important. We've only got a few minutes left. Is there any other questions, anyone, that you want me to answer while we've got 5-6 minutes left? If there isn't, we can finish off. So now's the time, and hopefully I've answered everyone's questions. Going, gone. Perfect. Thank you so much. Thumbs up will be great, everybody. Listen, thank you so much, everyone, for attending. Hopefully that's added value to your journey. As promised, you can clear a mortgage in about 7 years if you want to, and this is the value, how you add it. And hopefully you feel enlightened. It's given the huge value, and it's driven that. If you're watching this after, hope you're getting value as well. Whenever you watched it, do drop us a message. We love giving value. If there's any other topics you want us to cover, this is the time to let us know, and we'll develop that webinar to cover that. Have a lovely evening, everybody. I hope you enjoyed it. Thank you so much. Thank you. Thank you so much. How was that, people? I think that we didn't get, the people are not turning up.